When you look at a company's financial reports, there's one number that gets all the attention, right? Revenue. It's the top line, the one that tells us if a business is actually growing. But behind that one single number is a really big and surprisingly tricky question.
Think about it. When should a company actually count the money it's bringing in? Is it when they sign a contract? Is it when the cash hits their bank account? Or is it maybe when the customer gets the thing they actually paid for? It sounds simple, but getting this wrong, well, it can be a massive problem.
Because the answer to that one question pretty much defines a company's financial health. It drives investor decisions, it moves stock prices, and it's fundamental to our trust in the market as a whole. So yeah, getting it right is absolutely crucial. Let's dive into how the world of accounting finally tackled this. So before we had a single global standard, the answer to our question, when is a sale, was, let's just say, a complete mess. You had companies in different countries, sometimes even in the same industry, playing by completely different sets of rules. Just imagine this for a second. A gym could take your annual membership fee in January and book all of that cash as revenue right then and there, even though they owe you a full 12 months of service. Or a software company could sell you a 3-year license and recognize the entire payment on day one. As you can imagine, this made it almost impossible to truly compare two companies and get an honest picture of how they were actually doing. So, to fix all this chaos, the world's top accounting experts got together to create one single unified rulebook, and that solution has a name: IFRS 15. IFRS 15 stands for International Financial Reporting Standard 15, and its whole purpose is to bring consistency and clarity to reporting revenue. Honestly, the best way to think about it is as a universal translator for sales. It makes sure that $1 of revenue reported in Tokyo means the exact same thing as $1 of revenue reported in London or New York. So how does it do that? Well, it provides this really clear, logical 5-step framework that every company has to follow. And to see exactly how it works, we're going to walk through a super common example: signing up for a new mobile phone on a 2-year plan. This right here, this is the roadmap. It takes a company all the way from the first handshake to actually booking the revenue in their financial statements. It just forces them to ask a series of really smart questions to make sure the revenue they report genuinely reflects the business they've done. All right, step 1. First things first, is there actually a deal here? Step 1 is all about confirming that a real, enforceable agreement actually exists between the company and the customer. Now, this contract doesn't have to be some 50-page legal document. It could be written, it could be verbal, or it could just be implied by how a business normally operates. The key things are that both sides have agreed to it, the terms are clear, and it's pretty likely the company is actually gonna get paid. So in our phone plan example, the moment you sign that 2-year agreement, yep, we've got a contract. Step 1, check. Okay, with a contract in place, we move on to step 2. Here, we have to figure out exactly what the company has promised to deliver. In the official lingo of IFRS 15, these promises are called performance obligations. A performance obligation is really just any distinct good or service that's been promised to the customer. So let's think about our phone company. What did they actually promise you? It's not just one thing, right? They promised to give you a physical phone. That's one performance obligation. And they promised to give you network service for 24 months. That's a second, completely separate promise. And making this distinction is going to be super important for the next steps. Step 3 is nice and easy. What's the total price tag for the whole deal? We just have to figure out the full amount of money the company expects to get for everything in the contract. For our mobile phone plan, the total cost over the 2 years is $1,200. That's it. That number is our transaction price. Simple as that. Okay, now we get to the really clever part. We take that total price from step 3, the $1,200, and we have to slice it up. We allocate a piece of that total price to each of the promises we identified back in step 2. So how do we split that money? It's not just a random guess. The rule says you have to base it on the standalone selling price of each item. In other words, what would the phone cost if you just bought it by itself? And what would the service cost on its own? So let's say the phone sells for $720 and the service would be $480 over 2 years. That's how we allocate our $1,200 price. And that brings us to the final and most important step. This is really the whole point of the exercise. A company can only recognize revenue when or as it actually keeps its promises and satisfies those performance obligations. And this is where it all comes together. Remember our two promises? The first one was the handset. When is that promise fulfilled? The second you walk out of the store with the phone in your hand. So bam, the company recognizes that $720 immediately, at a point in time. But what about the network service? Well, that promise is delivered continuously over 24 months. So the company recognizes that $480 over time, which works out to $20 a month every month for 2 years. So we've walked through the whole 5-step model. It's a pretty logical process, right? But why does this matter so much in the real world? Why should you actually care about all this? Well, it matters because this framework forces financial statements to tell a much more honest story about how a company is performing. Investors can finally compare apples to apples, whether it's Verizon versus AT&T or two different software companies, because now everybody's playing by the same rules. And hey, remember that gym? Under IFRS 15, they can't book that full year's fee on day one anymore. They have to earn it month by month. This simple principle creates so much more confidence and trust across the entire financial system. At the end of the day, what IFRS 15 really gives us is a shared language for how we talk about creating value. It's a clear set of rules that leads to clearer, more reliable, and just plain more understandable markets for every single one of us. So the next time you see a headline screaming about a company's record-breaking revenue, you'll be able to look at it with a whole new perspective. You'll know that behind that one big number is a systematic process of identifying promises and only counting the money when those promises are actually kept. You'll be able to ask the right question: what value was really delivered and when? And understanding that is the key to understanding the real story of any business.